Have you ever just stared at a trading chart, completely lost, wondering which way the market's actually headed? Well, if that's you, then you've come to the right place. We're going to dive into a professional technique called multi-time frame analysis that honestly just cuts through all that noise and brings some serious clarity, whether you're trading gold or really anything else. Man, this just hits the nail on the head, right? A Reddit user perfectly captured that feeling of being totally buried by your own analysis. You think adding more stuff, more lines, more indicators is supposed to help, but it just ends up making things 1,000 times more confusing. Yeah, I am guessing that sounds pretty familiar. That feeling of looking at a chart that looks more like a modern art piece than a roadmap to a good trade. That's the exact trap we're going to talk about breaking out of today. It's a super common problem, but believe me, you can learn to sidestep it. Alright, so let's call this what it is. It's what happens when you're just lost in the noise. You've got conflicting signals everywhere, you're getting chopped up by the market, and you end up feeling totally paralyzed right at the moment you need to act. Yep, this is what we call analysis paralysis. Your charts are a complete mess of lines, one indicator screaming buy while another is screaming sell, and you're just frozen, second-guessing everything. And here's the kicker. This almost always leads to the biggest mistake you can make, trading against the market's true direction. But look, it's not that you don't know enough, it's that your entire approach is flawed. So, how do we fix it? Simple. We zoom out. You have to see the whole landscape before you start looking at the tiny details. And that's where our solution comes in. Multi-time frame analysis. Think of it as a GPS for your trading. So what is multi-time frame analysis, or MTFA really? It's just a system for looking at an asset on different time scales. You know, looking at the weekly chart, then the daily, then the hourly. It's kind of like buying a house. You don't just look at the front door, right? No, you walk around the whole property, you check out the backyard, you look at the foundation. MTFA does the exact same thing for a trade, giving you that complete 360-degree view. And look, this isn't just some nice idea. It makes a real, measurable difference. The data shows that traders who use 3 or more timeframes see their average win rate jump from about 45% all the way up to 60%. That's not just a little bump. That is a massive statistical edge, and you get it just by changing your perspective. Okay, so we know what it is, but how do you actually do it? Well, pros follow a really simple, disciplined process to keep their emotions out of it. It's called the top-down method. Now, this is so important. Amateurs, we often start on a tiny 1-minute or 5-minute chart. We see a little pattern, and we try to make the big picture fit our tiny view. That's bottom up, and it's a recipe for disaster. The pro way is top down. You always start with the big picture, the higher time frame, to see where the market is really going. Why? Because that's where the big money, the institutions, leave their footprints. This one change can make all the difference. And the process itself is literally just 3 steps. Step 1, on your big chart, like the daily, you find the main trend. Is it going up or down? That's all. Step 2, you zoom into a middle chart to find a specific setup that's moving with that trend. And finally, step 3, you use the smallest chart to nail your exact entry and exit. Trend, setup, entry. It's a logical flow, one step right after the other. This is what a lot of traders call the rule of 3. It's a super easy way to remember that each time frame has one specific job. Your higher time frame answers, what's the overall trend? Your middle time frame answers, where's a good setup? And your lower time frame answers, when do I get in? See? Trend, setup, entry. Each one has a simple question to answer. And what's so cool about this is how flexible it is. It works no matter what your trading style is. If you're a swing trader, you might use a daily, a 4-hour, and a 1-hour chart. A day trader, maybe a 4-hour, 1-hour, and 15-minute. The specific times might change, but the top-down logic, trend, setup, entry, it stays exactly the same. Alright, enough theory, let's make this real. We're going to walk through a simple gold trade to see how all these pieces actually fit together. Okay, step 1, we look at our highest time frame, the daily chart for gold. Which way is it going? It's clearly going up. End of story. Seriously, our job on this chart is done. From this point forward, our brain is programmed to only look for buys. We are completely ignoring any and every signal to sell. Okay, next we drop down to our middle chart, the 4-hour. We're hunting for a setup that agrees with our buy-only plan. And look, we see the price is pulling back into a known support zone. This right here becomes our area of interest. We're not pulling the trigger yet, we're just identifying the location where a great trade might happen. And now we drill down to our entry time frame, the 15-minute chart. Here, we're acting like a sniper. We are waiting patiently for one thing, a trigger. We need the market to show us, hey, the little dip is over and the big uptrend is kicking back in. A strong candle pattern, like a bullish engulfing handle, is the perfect green light. That's when we execute. What we just did there is create something called confluence. It's just a fancy word for when all the pieces of the puzzle snap perfectly into place. All 3 time frames are telling the exact same story. Our daily chart gave us the trend, up. The 4-hour gave us the location, pull back to support. And the 15-minute gave us the trigger, go. When you get that kind of alignment, your odds of success just go through the roof. Now, this system is incredibly powerful, but it's not magic. There are definitely a few big mistakes that can totally wreck the whole process if you're not careful. So let's talk about what to avoid. First, don't use 5 or 6 time frames. Stick to 2 or 3. More is not better, it just brings back the confusion. Second, and listen up, this is the big one. Never let a signal on a tiny chart convince you to trade against the trend on your big chart. That is the cardinal sin of trading. Third, don't wait for a textbook perfect setup. Sometimes good is good enough. And finally, don't let every little wiggle on your entry chart scare you out of a good trade. Trust the bigger picture. So let's kind of wrap all this up by talking about the real goal here. This isn't about learning to be a fortune teller. It's about becoming a strategist who knows how to stack the odds in their favor. And this right here is probably the biggest takeaway of all. Multi-timeframe analysis does not give you a crystal ball to predict the future. What it does do is align you with the powerful forces in the market right now. You stop trying to guess what's going to happen and you start trading based on the high probability evidence of what is happening. And the proof is in the numbers. The data shows that when traders only take setups where all 3 of their chosen timeframes are aligned and telling the same story, their win rate can climb as high as 71%. That's the power of trading with the flow, not against it. And this quote just sums up the whole philosophy perfectly. You don't take a trade just because the price hit some line you drew on a chart. You take the trade because the entire market structure, across all your timeframes, is telling you that now is the moment to act. So, I'll just leave you with this one question to think about. Take a good, honest look at how you trade. Are your trades built on a solid foundation of alignment and evidence? Or are they really just based on a signal from a single chart and a little bit of hope? The answer to that could change everything for you.